Hello everyone, Steve Lentz here with the Inside Wire. It is April 11th, 2017. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Welcome everyone. A little bit about me. I ran for re-election as mayor in my town of 31,000 people. And we had this election last Tuesday. And unbelievably, 4,900 people came out to vote. It was which for us is a pretty good turnout. There's 16,000 registered voters. It's a turnout of, you're pushing 25%, 25%. The rest of the county, it was at 15%, an abysmal turnout. But in our town, it was a hotly contested race. Get this, I'm ahead unofficially by 13 votes. 13 votes. Incredible. And so now we're waiting for the mail-in votes to drift in. I understand there's roughly another 40 or so to go, something like that. And in a week from today, they're going to open the ballots, send them through the counting machines, and I'll know if I won or not. So it's pins and needles, but it's a 4-year term. I'd love it if I got elected again and continued some of the stuff we're doing in town. A lot of redevelopment, and it takes forever to get redevelopment projects going. And right now the table's set to see something big happen over the next 4 years. So I hope I make it, but it certainly is enjoyable. Thanks for joining us. I want to go over a study that Jim Graham and I did. And this caught my eye because I have been asked. Let me back it up. I have been asked. I think twice I have heard this. In a fairly short order from different sources, more interest in unusual options activity. And one of it was a football coach of mine, an acquaintance of mine, just the other day at the football field. We were doing 7-on-7s. I'm with the high school, the local private high school. Then they have a good state contending program most years. But I ran into a guy, we're talking, and yeah, I understand you do options and this and that. He goes, I'm looking at unusual options activity and trying to get involved in that. And I thought, well, it's interesting he mentions that because I had heard something about it, within the last few weeks from someone else. I thought, all right, maybe this is catching on a little more attention. But I want to I just want to present the results of a study that Jim Graham and I did back in 04 and 05. And we were running an advisory at the time of a different nature, and we would just constantly, every day, run an OpScan on unusual call activity that day. And we just built up roughly 18 months of daily OpScan reports of just one OpScan, unusual call activity, and we built it up over time, this big database of companies that had hit on this particular OpScan. So then after running this for 18 months, we then went back and in hindsight, went back to see if there was anything to this. And I want to report to you the results of that. And I remember us compiling this data because Jim and I at the time were running a monthly report in Options Trader magazine. And it was called the Options Strategy Lab. And what we would do is do a different back test of a different trading system every month. And it would take about 1 or 2 pages, maybe 2 pages or so, of this magazine. And it was just a monthly article that Jim Graham and I were putting together and having published every month. And it was a lot of fun. I would have to do some back testing work. He'd compile it, write an article on it, on the report, and we would publish it, and he and I were the 2 authors. So 2 of the months we dedicated to unusual call activity and running the analysis of these 18 months of daily downloads of the OpScan report. And because these magazines, they got a deadline, it was killing me to make the deadline because it turned out to be a pile of work, and I had a deadline. I think I pretty much pulled almost an all-nighter on one of these months. It was really crazy because especially I think it was the first one. The second one was much easier because there was fewer stocks. So I want to go over this a little bit with you, and I think you'll find it to be of interest in any case. So let's go through here. So on the first one, and this is from January of '06, and we began doing this in April of '04, of doing the daily OpScans. Okay, and I'm going to walk you through the articles, but basically we're looking at optionable stocks, and so this is for the first of the two articles we wrote. And so the system we were looking at was based on the idea that unusual call option activity often precedes takeovers, buyouts, other important news announcements. That's the premise. By looking for unusual activity in a stock's call volume, the system hopes to enter the market before the news breaks. Makes sense, right? All right, so here's what we did. We scanned the stocks, the equity markets, for potential large gains in a short period of time based on the following criteria. All right. The stock had to have at least $250,000 in options traded that day. Now, there's a lot of stocks that don't trade that much. Certainly back then did not trade that kind of volume. All right, so that limited it. One could expand on that and maybe have different results, or maybe taking any stock that trades between 10,000 and 250 and get different results. But anyway, for our study, that's what we looked at. Okay, now all this is going to be equated into an OpScan report in just a second that you could easily input, and you should have one that's pretty darn close, the default in your program if you have OpScan. The total dollar value of options traded on that day had to be at least 5 times larger than the average dollar volume of options over the past 5 trading days. That's inclusive of puts. Okay, so we need the total volume to be 5 times the 5-day average. Now, the dollar value of call options had to be at least 3 times larger than the dollar volume of the put options. And we like doing dollar volume because that's a more authentic measure of trading, of true volume. Okay, and liquidity for that matter. Stocks whose implied volatility reading for that day had to be at least 5% higher than the stock's average IV for the past 20 trading days. Okay, so we needed IV to pop. So here you have calls exploding in volume, and you have implied volatility going up as well. All right? Okay, so what happens when you get this candidate then? If all of those guidelines are met, you would basically buy $2,000 of the underlying stock, okay, at the next day's open. At the next day's open. So you're running this OpScan at night. Next day's open, you're buying $2,000 of stock. The test analyzed how those trades performed over the next 5, 10, and 15, or excuse me, 5, 10, and 20 trading days. So we would basically buy at the open and then check in 5 days later, 10 days later, and 20 days later to see how well that stock purchase did. And that's basically the study. Okay? We were looking at all the optionable stocks at the time, which were over 2,500 at that time. Commissions were not included, and all trades were using the current bid and ask prices on those stocks. We started April 1st, '04, going through December 9th of '05, roughly 18 months. There were 190 days in which at least one stock met all the criteria, and a total of 1,046 stocks met those guidelines during that period. And that's why I pulled an all-nighter. I had to do this study, we had to check in 5, 10, and 20 days on over 1,000 stocks. So this took me a little bit of time to do, and it was done by hand. Okay, I remember distinctly. All right, so here is the OpScan formula. Now, in your OptionVue program, if you go to OpScan, you should have something that looks very similar to this. Maybe it's a little bit different, but there is a default formula in there called unusual call activity, and it should be very close to this. So here you have it. I provided the PDF download for you if you need. Yeah, under shared files, you have access to that. And if you want to duplicate this, you can certainly give that a shot. One moment here. Okay, now what happens? Click. All right, and by the way, this morning when I ran this at about 10 o'clock Central, Canadian Natural Resource, CNQ, came up, and you can see that the 5-day volume was at 74. The 5-day average total dollar volume was at 74. Today, as of 10, it was at 554,000, several times what it is. 7.5 times? So total volume grew by 7.5 times from the average up to today. So something's going on here on this. Okay, on CNQ. That'd be an interesting one to take a peek at. So here you have the, maybe I should go over this total volume. Now we do have the Schedule A and Schedule B. For those of you into OpScan, we do have the schedule that gives you all of these parameters. If you understand an Excel spreadsheet, you should be able to easily acclimate to the language that in our OpScan we use. It's fairly simple. But these are the 4 parameters that need to be met right here, expressed in terms of an OpScan language. I'm sorting by the total dollar volume today divided by the 5-day average. And that's why we're getting that 7.5 number. Pretty strong. All right, so what I did is I created a spreadsheet of all 1,048 stocks, and I put in the next day's opening price, the number of shares purchased, the price 5 days later, and what the percent move was from when we got into it. From this cell to that cell. We looked at the total profit, and then we looked at the same amount of data 10 days later, and then 20 days later. So you can see here that we have the percent moves on the 5 days. Some of these pretty good 5-day moves here. Look at this. Here's a string. It's a nice string. Some of these are also on the other side, -6% there, etc. And it kind of goes all over the board. Well, here's one. We were up 5.8% in 5 days. When you go out 10 days, we're down 21.5. Finishing up 20 days, we're down 19, a little over 19.5. Here's one where the company filed bankruptcy. It went to 0. Literally, the stock went to 0. You don't see that very often, but there it is. But you had unusual call activity at one point. So you can see that this is going to be somewhat volatile amongst these 1,000 stocks here. I also want to point out you certainly have days where you are not getting anything. On the 11th you got nothing. On the 8th you got nothing. So whole days will go by. In this case, look at this, almost at least half a week went by with nothing. Some days you'll get several. Look at this. On the 16th you had 4 popping right there. So we took every one that showed up for that period of 18 months, threw it on here just to see whether there's validity in unusual call activity like this. And here I compiled the spreadsheet above, and then down below, this is what it looked like in the magazine when it was compiled. The total profit, right here, after 10 days, after 20 days, the total profit there, and number of winning trades, the winning percentage, a little over, we could see that in this case, you had to go out 20 days and then you had a winning percentage that was much, much better. The average, let's see, the average profit on the winners was at 337. The average loss on the losers was a little bit higher. So it's pretty much a scratch, to be honest. It's a turkey shoot in a way. We're not seeing an edge just simply taking this by itself, just because it has unusual call activity, when you take the whole sample and don't do any filtering beyond the fact that it has unusual calls, you're pretty much getting something around 50% gains, 50% winners, 50% losers. You're not seeing, let's see, are we seeing any average profit of the winners? Well, here you have an edge on the 5-day, 97 compared to 90. Okay, so there's a little bit of an edge there. Right around 50%, and the average winner is more than the average loser. So you have an edge there. And then you have, there's a very small edge going on here. I guess you could, if you interpret this that way. Okay, now, what we thought then after that, Jim and I got done with this mammoth project, and then thought, well, what if we did filter this? Let's take a stab at doing a technical filter. Because what if these unusual call report, these stocks are popping on the report, yet the market is in a big tailspin? What is that going to affect things? So here's what we did. We did the second one, the February 06, let's see, 4th. Yeah, the February edition of 06. And we applied some technical filters. We applied technical filters to the list. And so instead of having 1,000, we dropped it down by hundreds and hundreds, down to somewhere around 300 or so. And here's what we did. We excluded stocks that traded below 750. We wanted to only trade when the stock, when the broad market, the S&P 500, was above its 50-day simple moving average. And then we wanted two different momentum indicators to be bullish. We wanted the stochastic, a 15-12-5, to be in an uptrend where the K was above the D, and we wanted the MACD indicator to be bullish as well, where the MACD line was above its 9-day average. So we wanted both to at least be bullish. We didn't care where they were, what the actual values were, whether we were overbought or oversold or whatever. We just wanted them to both register as being bullish. And so when I put it in my Metastock program, this is what we get. And we just want these both to be kind of, agreeing with each other. Just like that. And then I would paint the bars blue where we had that agreement. And it's only on the blue bars then where we would then the next day enter in on on an order. Now, since we were recasting this study, we thought, what the heck, instead of just going long the stock, let's go ahead and go long some calls and try and extract some more profit than just going long the stock. So we went back, and went back, and for these 200 and whatever number here, we'll see in a bit, we went back and purchased the nearest, roughly the first expiry over 30 days or so, and we bought at the money options, at the money calls, and wrote it out, because it turned out that the 10-day mark turned out to be the most profitable all in all in doing this. I did the study in terms of stocks, found that the 10-day was the better of the three periods. Then we just bought calls, held on to them for 10 days, looked up in 10 days and see if we made money. That's how this one in particular worked. And so what you'll see here, let's go back. Here I'm going back to 04 when we started this. Take a look. And you'll see that we had some agreement at the beginning of April. We had it at the end of May going into June, and then we took several weeks off, a couple months in fact, before it fired up again back over in late August going into September there. So we didn't do anything during this period of time. And this is reflected here. You'll see a big swath of time removed. Pretty much all of June, July, and August are gone, and we don't fire it up again until September there. So we're indeed trying to weed out those periods where the market is moving downward, and we don't have the momentum agreement when we're above the 50-day moving average. So how well did this do using options instead? Okay, after applying these filters, the system measured the performance of 278 stocks in the next 5, 10, and 20 days and found that those stocks performed best during the 10-day holding period. 165 winners, 113 losers. Okay, that's better. Certainly is better. The filter definitely created a better percentage of winners here. No question about it. That's when we went, okay, let's do options instead. So instead of just buying the stock, all right, that met all those guidelines, the system used $2,000 to purchase as many at-the-money calls as possible at the close. We bought the nearest month options that had at least 30 days until expiration and exited at the close 10 days later. Okay? So, here's what we did. The test results. The system generated $16,650 in profits using $100,000 in capital over the 20-month test period. 10% annualized gain. You're in for a wild ride. Monthly losses of 20% were not unusual. It gained 56% in just 1 month. The biggest single winner was $6,400, a return of 320% in just 10 days. The bottom line here is buying call options led to more volatile returns than if we had simply purchased the stock, of course. When the underlying rallied, it often did not climb enough to overcome the call option's loss of time decay, all right, or decrease in implied volatility. If you simply bought the stock, you were at pretty much almost, over 59% winners, as I just showed you. However, if you bought calls instead, the winning percentage dropped to only 42%. Okay, so definitely applying technical filters to this increased our winning percentage from roughly 50 up to almost 60%. And here are the results. And and at the end of the day, this kind of, we've gone about, 11 years since Jim and I did this exhaustive study, and he and I worked hard at this. And it kind of left a bad taste in our mouth about unusual activity, to be honest, and you haven't seen it crop up in the curriculum here at Discover Options, just because here we really applied ourselves and found there to be a very minimal edge. It's not to say that you can't go through and you might find one that pops, as I showed you. There's one of them that had an outstanding, crazy return, but is that just going to be kind of because of randomness or luck? We also saw an example where 20 days later, one example, the company had gone BK. All right? So what you do see is more of a predictor of volatility. Some of these things really move. And if you go back up to see the, I'll show you this. We have some strong standard deviations here. We have an average move up or down, but the standard deviations of those moves can be pretty high. So it could be perhaps a predictor of future increased volatility in the stock, and that might be something to look at, as maybe using unusual option activity as a precursor to maybe buying a straddle. Something like that. You just don't know which way it's going to go, but we do know that there might be some additional volatility, and I'm just thinking out loud here, that might be the way to further research this, is unusual option activity like this, out of the blue popping, is that a precursor to enough of a big move that one could buy straddles and make some money that way? Now, that's an interesting question. Any questions, comments? Thought I'd throw this out there because, first of all, I don't think I've ever presented this live. It only appeared in the magazines back in 06, and to never be seen again. And only because it was kind of a wash and a minimal edge at that. But I think maybe additional study could be done in terms of predicting future volatility, come to think of it. And because when you look at the Look at some of these moves. You know, some of these are pretty strong moves. 5-day moves are pretty strong, 2 to 5%. The 10-day moves, let's see, the 10-day moves, some of these you get some double-digit moves. But boy, look at, I mean, on average, the 5-day moves look pretty strong, actually. And the 20-day moves look strong as well. But anyway, just something to look at. No questions, comments? Okay. Let's go back on. Folks, thanks so much. Any emails you have to me, other ideas on how to apply my subject matter here would be most welcome. And we'll talk to you later. Have a great rest of the week. Bye-bye.